Another way, either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close, not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40. Okay, 42, we're almost today. I think silver's going to do a big catch-up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of...
In today's episode, momentum analyst Micheal warns that silver is about to blast through its $50 all-time high and could reach $60 to $70 by year-end. While everyone watches gold hit new highs near $3,500, silver has been quietly building explosive momentum that's about to catch up with a vengeance. Oliver explains that silver is massively underpriced compared to other metals. Copper is above its 2011 high, gold is well above its 2011 high, and gold miners just broke their 2011 highs on Friday. Meanwhile, silver sits at only $42, making it either a piece of something you don't want to own, or it's lagged and going to catch up. The momentum expert believes it's the latter and expects silver to do a massive catch-up move. Moreover, Oliver tracks the gold-to-silver spread ratio and reveals that silver recently hit below 1% of gold's price, a level that historically signals major breakouts. In bull markets like 1979 to 80 and 2010 to 11, silver reached 3.5% to 6% of gold's price. If silver just reaches the historical norm of 2% of gold's value, it would nearly double from current levels. Now we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
I think silver is likely between now and year end, and maybe sooner than that, take out its old dual highs at 50. First off, they're phantom highs, meaning when we were there before, it was very brief anyway, like hours or a few days before it collapsed. But even in real dollar price terms, adjusting for the degradation in the money unit, which goes and increases in supply about 90% every decade, silver would probably be $100, $200 right now just to match those highs. Okay, and then put it another way. Either silver is totally a piece of something you don't want to own, or it's lagged and it's going to catch up. Now, what do I mean by lag? Look at copper. It's above its 2011 high. Gold, well above its 2011 high. Gold miners on Friday, XAU blew out its 2011 highs. GDX made a new high monthly close, not above the intra-month highs of 2011, but a new high monthly close. And silver's at 40. Okay, 42, we're almost today. I think silver's going to do a big catch-up. And I think while gold continues up, and now it's come up out of its 5-month wide range, 3,500 to 3,200 back and forth, just sleepy as hell, but no real break. And silver gained during that time quite a bit. The spread is starting to favor silver now, meaning what's the better performer? Yeah, right now silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge point. Okay, not that it's going to peak there, but that we're going to blast through those old nominal highs and not even pause until we get credibly out above them. and then maybe you get a correction of some kind. Not the end of the bull. But I think that's what we're facing right now. So yeah, momentum said, back in early June, watch out, I'm going to blow out the dual highs at 35. October last year, March of this year, we dropped all the way down to under 28 in that period of time. And when we came back up through 34, got up to the upper 34s again, momentum said, you're gone, you're going to take off. And I think it's only just begun. I think anybody who pays attention to those old highs as if they're important is illusory. Okay, it's for the reasons you just described. First off, they're ancient, and and look around you at the other base metal, copper, gold miners now. And why is silver? It's a dog? No, it's not. It's just been overlooked, and investors quite often do that. They make mistakes. They underprice things, they overprice things. In the case of silver, it's vastly underpriced. We're also watching something that very few people look at. We keep the spread between gold and silver. The way we do it is we divide an ounce of silver to an ounce of gold and express it as a percent. Silver recently got a pullback low that was slightly below 1% of the price of gold. Well, in our weekend report, we showed going back to 1975, what was the highest reading that silver-gold spread reached in each of those years. And 20 of those 50 years, it reached at least 2%. Okay? And in bull trends, like 79 to 80, 2010 to 11, silver was at 3.5% to 6%, the price of gold. Okay? Right now, we're, above 1%, and we're pushing up, toward 1.2%. Not far above here, when we run momentum of the spread chart, we're going to get a breakout. And when we get that, we'd expect the spread to also break out. Now, there's a level on the spread at 1.31%. What's that? Over the last 5 years or so, there have been 2 rally highs in the spread that halted at that level. You ever clear that, it's a horizontal range breakout for the spread. And historically, if you go back and look at this performance of that relative performance of silver to gold, whenever silver's beating gold, is surging upward, that converts into net price upside in both metals, meaning silver doesn't outperform gold because gold goes down more than silver. It's always silver outperform gold when they're both going up. Get the point? So while everybody's looking at price, we're also looking at the spread, and it's about to engage in a major breakout as well. And when it does, I think that spread is at minimum going to go to the norm of 2%. Well, heck, that's almost a doubling of its current relative value. I think it occur easily by year end. Now, what does that mean? Well, it means, if gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up during that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position is in the silver component of the monetary metals.
The technical analyst warns this bull market is fundamentally different from previous ones because multiple asset bubbles are breaking simultaneously. Stocks, bonds, Bitcoin, and the dollar are all showing critical weakness. Unlike past cycles where the Fed could print their way out of trouble, Oliver believes this time they won't have a Federal Reserve in a year or so due to institutional failures. Adding to the explosive setup, Oliver predicts oil will break out above $68 next quarter, triggering another commodity surge that will amplify precious metals gains. Combined with gold's momentum breakout after 5 months of sideways action, he sees conditions aligning for silver's long-awaited beast awakening. Now we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
Years now, we've had the phenomenon of governments excessively pushing the pedal and using money as their tool of survival. Okay. And in the process of decaying the real buying power of their money units, euros, yens, dollars, whatever, such that, what I mean, decaying the value. When your granddad built a house, it cost him $4,500. Now it's $450,000. Okay. That's an example of degradation of money over, a span of 100 years. it's created boom-bust cycles. We've seen them. We've seen monetary excess, and then stock market booms, and then stock market peaks and goes down regardless of whether the Fed cuts rates to try to defend it. It goes down anyway. And you get these boom-bust cycles created by monetary excessive flows, lower interest rates than reality would have them. Various monetary policies like QE, which they engaged back in 2008, which is now in their quiver, okay? You break the stock market in a few of the, especially certain arenas that I've been mentioning, including, by the way, the banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom-bust cycle game where they come in, they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point, will that work again? We argue no. This time it won't. This time the boom-bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher. Okay. When that breaks, real-world consequences occur. This time, I think they'll be so severe and also global, although we're a prime bubble. Some areas of the world aren't. China, for example, does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real-world, in-the-street consequences where certain things that we all take for granted but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay? It's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay? Which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to, raise the money, et cetera, that it can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print-awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money. We'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay, so to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know. Not really.
What do you think of today's episode? Do you agree with Micheal Oliver's prediction that silver will blast through $50 and reach $60 to $70 by year end? Is silver finally ready to catch up to gold's massive gains? Will this bull market destroy traditional financial institutions like the Federal Reserve? Post in the comment section down below your honest opinion. Share this video with someone who needs to hear this silver warning. Subscribe and click the notification button to get more updates. Thank you.